Welcome to the introductory session of Financial Accounting and Decision Making. This course will be offered in Term 1 of your PGP and will focus on understanding how managers use financial statement information in their analysis and appraisal of business performance to evaluate a firm's financial situation and position. Let's take an example of how this analysis is ingrained in us as humans. You have planned to pursue your MBA from ISB. Before you landed on that conclusion, you must have weighed the pros and cons of your decision, and we are sure you would have thought of the huge leap in salary that ISB will offer you while ensuring the loan is repaid without any hassle. If you think about it in depth, financial accounting was at the heart of your decision making. Today, my friends and I will help you understand how it is imperative to understand financial accounting to be a better decision maker, and how developing an understanding and appreciation of financial accounting rules and techniques is crucial for successfully managing a business enterprise.
Hey guys, so as Madhuri has already told you that we are here to impress upon you the importance of accounting in the decisions that you guys as a manager would be taking in your future corporate life. So to motivate you guys, I would like to start off with a couple of examples. So these examples are not for telling you or letting you know what skills you would derive from studying financial accounting. But in fact, these examples are to let you know that if you do not have a knowledge in accounting, how it can really turn into a disaster for you. So the first one, as you can see on the screen, is that of Mr. Bernard Ebbers of WorldCom. So for those of you guys who do not know, so Mr. Ebbers were arrested on the account of false financial reporting, which was to the tune of $11 billion. Having been probed, Mr. Ebbers' defense was that he didn't know financial accounting. But guess what? No one really listened to him, and he is currently serving a 25-year term in the jail. The second in the line is pretty much the same. This is Mr. Hori, the chief of LiveDoor. Again, was held for accounting malpractices, and again being probed, he was that his defense was that I never studied accounting, and hence he didn't know what numbers were going in his books or what was happening, what malpractices were happening. But again, no one listened to him, and he's also currently serving his term in a US prison. So what these two examples tell us is not that you should really know, you should have the capability of designing a complete income statement or a cash statement of cash flows, but you should know what numbers are going in your balance sheet or how it has been changed since last time. And if there is some manipulation that has been happening, you should be able to know how it has been done.
The objective of this slide is to give a sense of how critical the understanding of financial accounting be from a firm profitability standpoint. Let's assume you're the project manager of Procter & Gamble, the consumer good giant. You're assessing the possibility of launching a new product in rural India. You have an unmatched distribution network and supply chain capability and are almost convinced of the project's success. However, your finance manager indicates that the project's NPV, net present value, is negative. You will then be left with no option but to discontinue all efforts towards the launch. On the other hand, even if you do not have adequate sales strength or distribution network capabilities, you can still go ahead and launch the project if the NPV is positive. A lot of firms such as Amazon provide shared distribution platforms, and trained sales staff can be recruited on the go. The financial viability of a project is usually a critical decision point, and one can arrive at this only with a sound understanding of accounting.
Let us continue from the previous example of evaluating the project for P&G. Once you evaluate that it is a positive NPV project, you need to convince your majority shareholders. You might as well need to raise the investment from the new as well as existing shareholders. Let us assume that your three batchmates from your ISB class hold the majority stake in the firm. But unfortunately, they neither speak nor understand a common language. How do you get along with the situation of bringing them on the same page to raise the investment and make them understand that it is a positive NPV project? For this and many other similar situations, you and your investors need to have a common language for business. Accounting fills this gap by recording and processing all the business transactions and send across a common message among owners, managers, and investors. It standardizes the terms and means of communication between all the internal stakeholders as well as external parties involved in the business. As all the businesses across the world, regardless of the commodity or service they are dealing in, follow the same set of rules and standardizes the practices for accounting, it becomes easy for everybody to evaluate the business, its activities, transactions, and growth.
Let's pretend it's you. You're a student at ISB and you decide to opt out of placements and want to start your own business. Let's say you decide to do farming. You don't have a lot of money from your prior job. To start your farming business, you're going to need some financing. You go to a bank, you can borrow money from the bank and use that money to start the business. Unfortunately, you will have to pay that money back. So we call that money in accounting a liability, money that you owe or a company owes to other people. Once you have obtained the money that you need, you're going to purchase items that you will use in your farming business, such as a farm, barn, tractor, trucks, etc. You have used the money that you obtained from financing to invest in assets that you need in your business. Now that you have the assets you need to run your business, you can use these to operate your business and generate revenues. Let's say you took all the assets that you have and sold them to pay the money you owe to other people. The money that is left over is what you call owner's equity, the equity that the owner has in the business. Thus, the assets equal the money that you owe to other people plus the owner's equity, whatever is left over for the owners. This is the basic accounting equation. We will talk more about the details when you take up this course. So join this course to master the technical skills needed to analyze the financial statements and disclosures used in financial analysis. Classroom lectures, case studies based on real-life scenarios, financial records of a small business, and your turn activities in the class will guide you through the 3 most commonly used financial statements and read and analyze them to draw conclusions about a company's financial health. We look forward to see you in class. Happy accounting!